You wake up and check your phone. Prices are higher again. Gas costs more. Groceries cost more. Rent just went up. And somewhere, someone says the sentence you've heard 100 times before. Why don't they just print more money? It sounds reasonable. If money fixes problems, why not create more of it? Banks already create money, we know that, so why not do it endlessly? This idea feels obvious, almost common sense, and that's exactly why it's dangerous, because the ideas that feel obvious are the ones people stop questioning. Let me introduce you to Alex. Alex is 32, works a stable job, gets paid every 2 weeks. Alex isn't irresponsible. Alex budgets. Alex does what they were told to do. But every year, life feels tighter. Not because Alex is spending wildly, but because prices keep moving faster than paychecks. Alex hears politicians say they're helping. Alex hears the news say the economy is strong. But Alex's bank account tells a different story. So Alex asks the same question millions of people are asking quietly. If banks can create money, why don't they just create enough so this stops happening? Here's the first thing most people get wrong. Banks don't start by printing money. They start by lending. The moment a loan is approved, money appears. Not transferred, not moved, created. When Alex takes a loan, new money enters the system. And this is where most explanations end, because once people hear this, they assume banks have unlimited power, that if money is created digitally, then there must be no limit. But that assumption misses the cost hidden inside every dollar. Every dollar created comes with debt attached. That debt must be paid back, with interest. Creating money isn't free. It's a promise about the future. A promise that someone will produce enough value later to justify that money today. Infinite money would require infinite repayment, infinite income, infinite growth. Pause for a second. Can Alex work infinitely harder every year? Can the economy grow forever without slowing? No. The real world has ceilings, and when money grows faster than reality, something has to give. What gives isn't the money supply, it's prices. Alex finally gets a raise. It feels good. For a moment, then rent adjusts, food creeps higher, insurance renews at a higher rate. The raise disappears. This is why inflation feels invisible at first. It doesn't hit all at once. It leaks, slowly, quietly. Printing money doesn't create more houses. It doesn't create more food. It doesn't create more energy. It only changes the numbers used to compete for them. This is where people start blaming the wrong things. They blame companies. They blame greed. They blame politics. But inflation is not emotional. It's mechanical, and it follows rules. When money enters the system faster than production grows, purchasing power falls. That's not an opinion. That's arithmetic. And once you understand that, inflation stops feeling random. It becomes predictable. Now here's the part schools never explain. Banks are not limited by deposits. They don't need your savings to lend. They need reserves. And reserves come from the central bank. But this does not mean banks can do whatever they want, because money is built on trust, and trust is fragile. If banks lend too aggressively, defaults rise. When defaults rise, balance sheets weaken. When balance sheets weaken, confidence collapses. And when confidence is gone, money stops functioning as money. So banks don't print infinite money not because they lack the ability, but because unlimited creation would destroy the system itself. This is why regulation exists. This is why capital requirements exist. This is why interest rates exist. These aren't arbitrary rules, they are brakes. And like all brakes, they feel restrictive only when you don't understand what they're preventing. When lending expands, everything feels good. Jobs grow, wages rise, asset prices inflate, optimism spreads, people feel smarter, risk feels safe. But when lending slows, the mood flips. Hiring freezes, layoffs begin, spending drops, fear replaces confidence. Boom and bust are not mistakes. They are built into a debt-based system. Credit expands faster than it contracts, and that's why downturns feel sudden. Alex used to think the system was broken. Now Alex sees something more unsettling. The system is working exactly as designed. It rewards those who understand it early and punishes those who don't understand it at all. This is why holding cash feels safe, but quietly costs you. This is why assets rise over long periods. This is why savings alone never keep up. And this is why people who don't understand money feel like they're always falling behind even when they're doing everything right. Once you see this, money stops feeling magical. It becomes mechanical. Banks will continue to create money. Inflation will continue. Assets will continue to rise over time. Cash will continue to lose purchasing power quietly, politely, without drama. The real danger isn't inflation itself, it's misunderstanding it. Because banks control the creation of money, but you control your awareness. And awareness is the first step to power. Not power over others, power over your choices, your timing, your financial future. This isn't taught in school, but it shapes your entire life. If this made things clearer, if it changed how you see money, this channel is for you. We break down the systems that control your finances and how to navigate them intelligently. Subscribe, because once you understand the system, you stop being surprised by it.